Hello and welcome back to the Note. Are we repeating history? Certainly US stocks are retracing some very familiar steps at this moment. Now, if we take a look at this first chart, what we're looking at here is how the S&P has done in red since the 17th of August last year. That was on the eve of the sharp fall it suffered after the unexpected Chinese devaluation. And then the blue line starts from the 29th of December, again, just before it started another fall after another unexpected Chinese devaluation. As you can see, the patterns are remarkably similar, both triggered by a similar kind of event, fell roughly the same amount, rebounded in much the same speed, and we are now in an echo of that period from last December when the markets lost conviction for a while. In line with that, today we saw the markets gain early on and end up in negative territory. Now, why exactly have we seen that pattern? Beyond those events from China, and we can hope that China won't spring another surprise, there are important differences. Back in at the end of last year, that rally was sustained even when it became clear that the Fed was going to go through with raising rates. This time around, the rally has been sustained in significant part because it's become clear that the Fed won't be raising rates. You could argue, therefore, that it's somewhat alarming that that hasn't been enough to push stocks through and out of their W pattern. What could break the pattern? Well, the most plausible candidate at the moment is earnings season, which is now upon us. Today we heard from Alcoa, which is the traditional starting point for the earnings season. It's not a particularly significant company or particularly typical company these days, so looking at it in great detail is a bit like looking at the results from Dixville Notch in New Hampshire for looking at US politics, but it is still intriguing. During the day, Alcoa's share price was up some 5%. After hours, it announced results that were very significantly better than expected, some 3 times better than expected thanks to the very low base, and in after hours trading it gave up all of its gains for the day. It hadn't been enough. Beating expectations hadn't been enough to keep people happy. Now that's intriguing because expectations are stunningly low. If we take a look at this next chart, we've excluded energy from this because energy stocks are expected to suffer a decline of more than 100% in their earnings year on year. If you take a look at this, you can see the red lines here show the expected year-on-year profit growth as of now, and you can see that most sectors, not even including energy, are now braced for significant declines, and that is a dramatic change from where we were at the beginning of this year and certainly from where we were a year ago. It is standard for companies to talk down their results as the announcement comes to give themselves a chance to set a low bar and beat it. It is not at all standard for results to be written down to this extent, and it's not at all standard for brokers to be braced for declines in profits on this kind of level when there's no recession, when there's no financial crisis. Now, either that means that there is something going on in the fundamentals of the profitability of corporate America that isn't apparent from the macro data, or it means that there has just been a big mistake and that there will be an opportunity for a big rebound once we discover that all of these fears for a big loss in profits have been overdone. What we've heard from Alcoa so far is a little concerning in that it doesn't look so far, on the basis of one company, doesn't look so far as though an earnings beat is enough to really push the share price forward. But this does look like a critical moment. If the market is going to break itself out of this pattern that it's been in for many months now, this earnings season, the results we finally learn from US companies over the next 2 or 3 weeks could be crucial to doing that.